According to a thorough new study by the World Bank, as central banks worldwide simultaneously raise interest rates in response to inflation, the world may be edging toward a global recession in 2023 and a string of financial crises in emerging markets and developing economies that would harm them permanently. Welcome back to another exciting video from Surgency. Today's video is about why 2023 will be worse than 2008. Before we start the video, please like, subscribe, and press the bell icon. According to the report, central banks have been raising interest rates this year with a degree of coherence not seen in the previous 50 years. This trend is anticipated to last well in the next year. To lower global inflation to pre-pandemic levels, however, the currently expected trajectory of interest rate increases and other policy interventions may not be sufficient. Investors anticipate central banks to boost global interest rates by more than 2 percentage points over their 2021 average through 2023 to about 4%. The study indicates that if supply disruptions and labor market pressures don't decrease, those interest rate hikes could leave the global core inflation rate, excluding energy, at roughly 5% in 2023, which would be near twice the 5-year average before the pandemic. The report's model suggests that central banks may need to increase interest rates by an extra 2 percentage points to reduce global inflation to a rate consistent with their aims. If financial market stress were to accompany this, global GDP growth would fall to 0.5% in 2023, a per capita contraction of 0.4% that would technically qualify as a worldwide recession. Global economy is severely dropping, and it will likely continue to slow as more nations experience recessions. David Malpass, president of the World Bank Group, expressed his grave fear that these trends would continue and have terrible long-term effects on people in emerging markets and developing countries. Policymakers might change their focus from cutting consumption to growing production to achieve low inflation rates, currency stability, and quicker growth. To promote development and the eradication of poverty, policies should work to increase capital allocation, productivity, and investment. The report emphasizes the highly complicated conditions in which central banks are now fighting inflation. Several past global recession indicators are already sounding the alarm. Following a post-recession rebound, the world economy is experiencing its most significant decline since 1970. Compared to the period leading up to previous global recessions, the loss in worldwide consumer confidence has already been much more severe. The world's 3 largest economies, the US, China, and the Euro area, have all seen a significant slowdown. Given the situation, even a slight blow to the world economy over the ensuing year might send it into a recession. The report analyzes the current trajectory of economic activity and proposes scenarios for 2022 to 2024 by drawing on lessons learned from previous global recessions. A countercyclical policy is often required during slowdowns like the one we are currently experiencing to support activity. However, even as the global economy slows dramatically, authorities in many nations are being prompted to withdraw policy support due to the prospect of inflation and constrained fiscal headroom. The experience of the 1970s, the ensuing stagflationary period, the worldwide recession of 1982, and the policy responses to the global recession of 1975 all highlight the danger of permitting inflation to remain high while growth is poor. The second lowest growth rate in developing economies over the last 5 decades, behind only 2020, occurred during the worldwide recession of 1982. More than 40 debt crises were precipitated by it, and many developing economies saw lost growth for a decade afterwards. Ahan Kos, the acting vice president for equitable growth, finance, and institutions at the World Bank, stated that the recent tightening of monetary and fiscal policies will probably prove helpful in decreasing inflation. However, given how synchronized they are across nations, they may be mutually compounding to tighten financial conditions and exacerbate the slump in global GDP. Emerging market and developing economy policymakers must be prepared to handle any potential spillover effects from a synchronized tightening of international policies. The study finds that central banks should persist in controlling inflation, which can be done without touching off a global recession. But it will require concerted action by a variety of policymakers. Central banks must communicate policy decisions clearly while safeguarding their independence. This could help anchor inflation expectations and reduce the degree of tightening needed. In advanced economies, central banks should consider the cross-border spillover effects of monetary tightening. Emerging markets and developing economies should strengthen macroprudential regulations and build foreign exchange reserves. Fiscal authorities must carefully calibrate the withdrawal of budgetary support measures while ensuring consistency with monetary policy objectives. The fraction of countries tightening fiscal policies next year is expected to reach its highest level since the early 1990s. This could amplify the effects of monetary policy on growth. Policymakers should also put credible medium-term fiscal plans in place and provide targeted relief to vulnerable households. Other economic policymakers will need to join in the fight against inflation, particularly by taking decisive steps to boost global supply. These include easing labor market constraints. Policy measures need to help increase labor force participation and reduce price pressures. Labor market policies can facilitate the reallocation of displaced workers. They are boosting the global supply of commodities. International coordination can go a long way in increasing food and energy supply. For energy commodities, policymakers should accelerate the transition to low-carbon energy sources and introduce measures to reduce energy consumption. It is strengthening global trade networks. Policymakers should cooperate to alleviate global supply bottlenecks. It should support a rules-based international economic order that guards against the threat of protectionism and fragmentation that could further disrupt trade networks. That's all for today. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe to our channel for more exciting content.